Yeah, it's live now.
Great. Hello, everyone. Thank you for joining in on a Sunday afternoon. It's great to be here with all of you. I would like to thank all the organizers, the team at Tatwa and Entry for having me here. It's always great interacting with students. So, before I begin, a couple of pointers. If you have any questions, you can put them in the comment box. I'll go through them. Uh, After every couple of slides, I have basically, I'll be covering a few points as to why we should get into the stock market, and where should we invest, and when we should start doing it. So obviously we'll have questions. So if you have any questions, feel free to stop me, put it in the chat box, and I'll try and answer your questions. All right. So let's get started. I hope you guys are able to see my screen. So the first point that I want to cover is why invest or why trade in the stock markets or in any asset for that matter, whether it is stock markets, gold, real estate, crypto, whatever, right? To understand that, first we need to understand the inflation and its impact on our savings and the money that we hold, right? So, what is inflation? Inflation is basically an increase in price of the goods and services that we avail in our day-to-day life, right? In the table here, you can see 1 liter of milk, for example, in 1975 it was 3 rupees, and in 2021 it is around $50. So, in year on year, on an average, there has been a growth of 6.5% in this product, right? Similarly, if you look at petrol, this has been an increase of 9.46% year on year. And if you look at a movie ticket, everyone watches movies. So there's been an increase of almost more than 10%, 11.24% on an average every year, right? So what this tells us is whatever we consume, good or service, right? The price of those things are going to increase. Some are going to increase in the range of 6%, some are going to increase 9% per annum, some are going to increase more than that, 10, 12, 13%, right? But the money that you are holding, the 500 rupee note that you are holding, that its value is not going to increase. It is not going to become 520 or 540 in 2 years or 3 years time, right? So that remains same, but the cost of goods and services increases. So what you are able to avail with the money that you are holding becomes lower and lower, right? So this is historically how the inflation has been for the past around 30, 40 years. If you look at this, we've trended, the low is around 3 to 4%, and the high is around as high as 13, 14%, right? And in this graph, you will see it's cyclical in nature. It will go down, then it will go up, again come down, again go up. So right now, we are around 4 to 5%. Uh, 5 to 6% actually in 2021, 22. So what this tells us is this is again not a linear trend that we see. Inflation goes up, comes down. This is the way it happens, and there are years when the inflation percentage is even higher than your fixed deposit, right? So if you look at years like 1999, 1991, the inflation was as high as even 2008, 2009. Inflation was as high as 12%, whereas the FD returns were less than 12%. So if you've done an FD, let's say at 8% back in 2008, you're losing money because the value of money, your FD is increasing it by 8% per annum, but the interest rate is increasing it by 12%. inflation is decreasing it by 12%, right? So in a right, for someone who's saving, let's say, to buy a home in 2021, assuming that the price of house in 2012 was 1 crore, then in 2021 it would have gone up by 60% approximately, given the trend that we see. So now the cost of house, which was 1 crore in 2012, has become 1.6 crores in 2021. So if you are saving, assuming the 2012 rates, you will be short by 60 lakhs, right? Similarly, our expenses will also grow, right? So if you're spending 30,000 per month uh, presently to take care of your lifestyle, 10 years later, this will go up to an approximate 48,000 per month, right? So, what is the solution for this? How do you take care of this inflation? Is by investing the money. So the money has to grow at a minimum of what you have as the inflation percentage, right? So generate returns equal to the inflation to avoid depreciation of your money, right? So that's the basic minimum thing that we need to do. And if you want to create wealth, right, then you need to uh, get returns on your savings which are higher than the inflation percentage, correct? So that's the crux of it. Why we need to really invest our money is to take care of inflation, right? And to make sure that we are getting returns which are higher than inflation. Only then our money grows. We are able to sustain. Otherwise, the value of money that we hold keeps on going down, and life becomes difficult with the value of money going down for us. So that's the first piece, like why we should get into investing and trading. Any questions so far? I'll just look at the chat box if there are any questions. uh, I don't see any questions, so all good, I guess. Great. So moving on. um, So now that we know why we should be investing, the next question is, where do you invest? There are so many options available in the market. There's different asset classes. There is gold where you can invest. There is stocks where you can invest. There are mutual funds. There are debt funds. Nowadays, there's a lot of craze of crypto. So crypto is another asset class which has come up. Uh, so, amongst all these things, where do you really invest? So, that is what we are going to cover in our next section, where we talk about the various asset classes. All right. So, where to invest? So, first, let's understand what is an asset, what is an asset class. So, asset is anything that appreciates in value over a period of time, right? So, for example, would you call if you buy a car, right? Is that an asset? The answer is no, because the value of a car will go down over a period of time. If you bought it at 10 lakhs today, after 5 years, it will be probably around 5 lakhs, 6 lakhs. Sorry. So that is not an asset. Asset is something that appreciates with time. Maybe if you book an FD, a fixed deposit, that is an asset, because yearly you will be getting some interest on that. So your money will grow. The value of the asset will grow. Similarly, stocks are also an asset class where over a period of time, gradually the money grows. Right. So that's what an asset is, and we club the various type of assets into something called a asset class. So let's look at some of the asset classes. So equity, which is stocks, equity-oriented mutual funds. So mutual funds are nothing but a group of stocks that they buy, right? So that's a mutual fund. Uh, so that is also in the equity asset class, right? Fixed income is something which is risk free, where there's a guarantee of receiving money at the end of the tenure, right? For example, fixed deposit is a fixed income asset, where the bank and the RBI, which is the Reserve Bank of India, gives you a guarantee that this is the percentage return that you will receive at the end of the tenure, right? Similarly, there are government bonds, there are post office schemes, there are various debt funds. So all of those clubbed come under fixed income. Cash is also an asset, so that is that. And real estate is another asset class wherein you can buy a residential space or a commercial space or a plot of land, which is mostly expected to appreciate over a period of time, right? Then commodities are another set of asset classes wherein you can buy gold, silver, copper. Crude oil is also an commodity asset class, right? So I hope this is clear what an asset class is, right? So now let's look at how do we compare these asset classes. So if we were to invest, so first point is clear why we need to invest, right? Because there's inflation, it is eating away our money. Now we need to invest. So these are the various options available for us to invest, correct? Now, how do we know which is the better option, right? So these are the parameters which help us compare and decide what suits us the best, right? So what are the various parameters that we can use for comparison? First one is complexity, right? How easy is it to understand the asset class, right? So if you look at cash, for example, it's very easy to understand. There's no rocket science. As an asset class, cash is the money that you have in your pocket or in your wallet, right? Gold is also relatively simpler. It's traded across the world, and the price, you can just open your mobile and you can see what is the price of gold, right? Real estate, on the other hand, is slightly complex because there are various variables. You're buying a commercial space, you're buying uh, a residential space, you're buying a plot of land, what is the location, what is the city. So the complexity grows, right? So that is what I mean by complexity, how easy it is to understand it, what are the various parameters involved in assessing that asset class. The second, which is the most important, is what are the kind of returns historically that we've seen in those asset classes, right? Third is the volatility of returns. What do I mean by volatility of returns? Uh, so volatility of returns basically means, uh, are the returns linear in nature? Like in case of a fixed deposit, you know that at the end of the year you're going to get that 5%, 6% that was promised to you, right? So that's a linear return profile wherein the volatility is missing. But in case of the stock market, there will be volatility. One year you might get 2%, the other year you might get 30%, right? So it's not linear. The returns are volatile in nature. Okay. Then the liquidity of the asset class. So what I mean by liquidity is, uh, what is, how easily can I convert that asset into cash, right? So how easy is the transaction? So let's say real estate, it's not that easy to convert that into cash. You need to find a buyer, you need to discover the price of the property, right? And get a lot of bids, see what suits you, what is the prevailing price, and then probably sell it. So the process takes a lot of time, and there's a lot of paperwork involved as well. But in case of equity, the stock market, basically, you can just get up in the morning, punch your order, the prices are there on the exchange, and it gets sold, right? So the ease of liquidity, I would say, in the stock markets is fairly higher compared to something like a real estate, right? And the last point for comparison is the ticket size of the asset. So what is the minimum amount that I can invest in the asset, right? So for example, in case of gold, you can invest as less as 1,000 rupees, 2,000 rupees. You can buy gold for that. Similarly, equity also, even if you want, you can buy equity for $100. You can go and buy a share which is $100, right? But in case of real estate, that is not the case. You need to have a certain amount of money to be able to buy it. So let's now move on and compare the various asset classes. As you can see in the table here, in terms of complexity, fixed income has the lowest low complexity, cash has the lowest complexity, and real estate has the highest complexity. In terms of liquidity, real estate, the liquidity is high. Everything else, it's relatively high or very high liquidity. In case of returns, cash, we are below inflation returns. So if you're keeping something in your pocket, which is cash, it is actually not giving you any returns. So if inflation is 5%, 6% per annum, then you end up getting returns which is below inflation because you're not getting any returns there, right? And equity, you get above inflation. Fixed income is near inflation, so FD would generally give you returns which are similar to inflation. Real estate will give you above inflation, and gold is again near inflation returns. Now return volatility is higher in case of equities. Cash, there is no volatility, and gold is also high. Real estate, the more volatility is medium. Ticket size, the lowest, equity, fixed income, all of this is low to medium. Real estate, obviously, is on the higher side. Right. So, what do we conclude from this? If you look at the absolute numbers, it's clear that when we compare the various asset classes, the equity is the best asset class which can beat inflation. So between 1980 till today, if you look at equity, the index Sensex, it has grown by almost 550x. Real estate is grown by 100x, gold is grown by 50x, FD is grown by approximately 12x. So this is the reason if you are investing and you're looking at long-term horizon, it is advisable to create wealth through equity, which is through the stock market, right? I hope this point is clear. If you guys have any questions so far, please feel free to put them in the chat box. I'll just have a quick look in case there are any questions. I do not see any questions, so I'm assuming all of you guys are able to grasp whatever I'm talking about, right? Cool. Now, till now, what we've covered is two things. One is why we should be investing in trading, and the second is where to invest. So the answer to that clearly is at this point in time, equity is one of the best places to invest. Now, moving on to the last point, when should we start? Right now, we know that we should be investing, and where we should be investing. So, where do we start? When do we start? Right. So, the answer to that I'll cover in the next section. Right. Why it is important to start early. So, I'll take an example to sort of demonstrate this. A practical example. So, let's say there's a guy called Amit who's 25 years old and he invests 1 lakh each year, right? Continuously for a period of 10 years, and then he stops the investment. So all he's investing is 10 lakh rupees between the age of 25 and 35. Okay. And his friend, whose name is Amar, he does not start early. He starts when he's 35, and he invests similar 1 lakh every year, but he does that till his retirement. So till he's 65 years of age, he'll continue to invest 1 lakh every year, right? So and the assumption is that both get the same rate of interest on their investments, which is 10%, right? So the total investment for Amit is what? It's around 10 lakh bucks, 10 lakh rupees. And for Amar, it is around 30 lakhs because he's started investing at 35 and stopped at 64. So my question to you is, who do you think will have a bigger corpus when he retires? The first guy is Amit is invested 10 lakhs. The second guy is invested 30 lakhs. Both are getting 10% per annum. Who do you think will have a bigger corpus at retirement? Okay, let's see. So the answer to that is Amit invested 10 lakhs and at retirement he'll have around 3.05 crores. Amar, who invested 30 lakhs, he'll end up having 1.81 crores at retirement. So basically, Amit would end up with 1.66 more money than Amar because he started early, right? And why is that? That is because of the exponential nature of compounding. That helps Amit. Even though his investment is one third compared to Amar. Amar invested 30 lakhs, Amit invested only 10 lakhs, but still his corpus is 1.68 times more than that of Amar, right? Uh, so I just want to emphasize the importance of starting early. You guys are young, and once you guys start earning, keep in mind the fact that the earlier you start, some part of whatever income you're making has to be invested early on, so that you reap the benefits of that as you go along in life, right? These are the calculations for someone who's interested, because this is not very trivial. A lot of people think that Amar who's invested 30 lakhs will have more money, but that's not the case. So these are the calculations for those who are interested. They can go through it. I just pause here for a bit to sort of let you guys go through it. So in case of Amit, he invests only for the first 10 years, and post that, uh, what happens is the interest that he earns on the total corpus is in itself greater than what Amar is investing, right? So yeah, again, the same calculation continued for those who want to get deep into this. All right, guys. I think this is all that I wanted to share with you guys. I'll open the floor for questions. I've kept some time. Uh, if you have any questions related to what we've discussed or anything else as well, like you want to know about the stock markets, any questions you have, please feel free to put them in the comment section so that I can answer those questions. Uh, yeah. So I'll just quickly look at the comment section if there are any questions. Doesn't look like. So I'll wait for a couple of minutes in case anyone has questions. They can put in there. Uh, yeah. If you have any questions later on, you can reach out to me on Twitter or on my email. I'll try and answer your question to the best of my ability. Yeah. Cool, guys. Anyone, any questions? Final call. Otherwise, we'll end the session. All right, guys. Thanks for joining in. I hope you guys got some sense of why we should be investing in trading, and how the process works out in your favor if you start early. So great being here with you guys. Even if some of you are able to make use of the session and apply it in your life, that would be That would make me very happy. All right. Thank you all for joining in. Take care. Have a nice weekend. Bye.